Hi, how's it going? My name is Anton. I'm one of the co-founder of Talos. Talos is a trading and institutional trading and prime services platform for crypto. So there's been, hi guys. There's been quite a lot of panels talking about institutional involvement in the sector and kind of, what is the projected institutional interest and when institutions are getting into the space. So I'm not going to focus on that too much. Instead, what I want to talk about is I want to talk about the ecosystem itself. What kind of infrastructure is there, what's available for institutions to actually get involved in a meaningful way in the crypto market. And first of all, just a couple of words about us. So the founding team is a team of, first of all, engineers. We get stupidly excited about new technologies. We try things out all the time. And we get very, very excited about technologies that we think might actually fundamentally change a bunch of different industries. So naturally, we got involved in crypto for Gary. Two is we are engineers from traditional markets. So we've been involved with majority of the buy side or the sell side firms out there. We have instrumented a lot of the institutional trading systems that actually are in use today by the larger organizations. And three is that throughout our careers, we made just a colossal number of mistakes, just a lot of errors. We've seen new asset classes come up. We've seen electronification of asset classes. So we kind of went through that phase as well. And we hope not to repeat some of those lessons. So on a personal level, we've been involved in crypto since about 2012 and started investing then. But over the last couple of years, we started seeing this trend where crypto looks like it's actually the beginning of a brand new asset class. Now, for somebody that's been in traditional markets for a while, that's actually a really, really big deal, right? You don't see that happen often. There's not another equities that are going to spin up. There's not another futures. And yet we're seeing something that is fundamentally different from what we've seen in the financial market space. And so we decided to get involved. And that was about a year ago. We started thinking about how to get involved. And the first thought was actually go after building a fund, which was admittedly a little bit greedy from our side. And immediately we kind of started seeing the challenges in the ecosystem. And the first and foremost is we saw a lot of liquidity being spread out between the different exchanges, OTC desks, a couple of other venues. And so you kind of you didn't have a connecting line between all the different liquidity in the market, so it was really hard to actually interact with the market systematically. So we ended up started building a lot of the infrastructure to connect to different exchanges. And that's where a lot of the tech issues started happening. So from a tech perspective, a lot of the exchanges just looked very, very different. The APIs were non-standard. There was no assurance of correctness. There was no assurance of availability. There's a lot of these kind of assumptions that we make in the institutional world that just didn't exist in crypto yet, right? So it was really, really hard to interact. And then the other side of it is OTC desks. So OTCs, to their credit, have done a great job at bringing liquidity to market, but the problem is the kind of tools that were used by the OTC desk for Skype and Telegram and text messaging. So not something that the institutional investor could get behind. And for some of the trading, the costs were prohibitive as well. So that was problematic too. So we kind of decided to take a step back and refocus and do something that we actually know how to do well, which is build institutional grade platforms. And that's what we're focused on. So the very first phase that we've been working on for the first year, which is this past year, is really tailored towards execution efficiency. And there what we're doing is we're effectively allowing our investors to view the market through the lens of our platform, right? So we're providing them with one API. That API is a standard API, very, very similar to what the institutions are using today. So we're providing FIX, we're providing WebSocket, really known state machines. So they know how to interact with those systems, they know what to expect. We're also providing a UI that's enabling them to view the market, again, in a very, very familiar lens, right? On top of that, we build execution layer that allows our institutions and our clients really connect to the individual exchanges and execute there. But they can also trust us and use our smart overriding algorithms to interact with the market. And of course, below that, there's a huge layer of connectivity. For phase two, which is going to be one of the next phases, we look at the capital efficiency notion. So right now, the exchanges require pre-funded execution, which in traditional markets is really pretty much unheard of, right? It's already hard for a retail investor, somebody private, to actually send money to the exchange. It's risky, right? So think about the kind of risk and the kind of sleepless nights you go over that, and think about what the institutional investor feels, right? The scale is much, much higher. And plus the money is actually not yours, right? You're literally betting on some exchanges you might not be familiar with, and you're betting with somebody's pension fund, which is a really bad deal, right? So what we're working on is working on a settlement layer that allow our clients to keep, a collateral on the side and allow the customer to interact with exchanges while not actually putting the capital at risk. So not incurring that massive counterparty risk with the individual exchanges, with the individual OTC desks, right? And so the goal is really simple for us. We want to make sure that our clients, the institutions, the funds, have an easy, a safe, and an efficient way to connect and become a meaningful participant in the crypto markets. And we believe that by doing that, we're going to push the ecosystem forward as well. Because what that brings is institutions are really interesting, right? It brings systematic valuation of underlying assets. We're going to see a lot more volume as a result, and we will likely see a more compounded volatility scale. So this is kind of like what we do. I'm going to be around. If you have any questions, I'm happy to take them now.
Yeah. Are you launched? Do you have customers? Where are you in terms of eating
Well, in stealth at this point.
It's what?
Like in stealth at this point, kind of coming out of stealth a little bit forcefully. We're launching in less than a month with the platform. We're going to launch it to beta, and we do have customers. Yes.
Funding, looking for funding?
We are not looking for funding. We are VC funded as of a couple of months ago, and likely there's, if there's any funding conversation, it's going to be down the line. Yeah, there's no need at this point.
How do you distinguish yourself from some of the other players who are tackling liquidity for institutional clients?
Well, I mean, first of all, judging, by experience in traditional markets, having competition is actually great. There's not going to be one winner takes all, and it's never going to happen. It didn't happen in any asset class in the market. So, and institutional investors are also never going to interact with the marketplace that only has one dominant player. That's just not how you evaluate your risk. That's not how you're able to do this. Having said that, and we have, by the way, great competitors, and they have awesome teams. But we have, except from the fact that we have quite a lot of experience in this, we've literally been doing this for the past decade and change for majority of the institutions and advising or actually propping up trading systems for those institutions. We have a slightly different way of building systems, right? We don't go feature first. The way you build the institutional system is very, very different from the way you build retail systems, and that's our mentality, right? 80% of what you're investing, 80% of your resources need to go into the less sexy features. You have to focus on correctness, you have to focus on availability, on reliability. What kind of support infrastructure do you have for institutions? Right now, if I'm trading with an exchange and the exchange goes down, I literally have nobody to call to. That's a disaster for a trader, for a professional trader. You have no idea what your position, that's a huge risk you're taking, right? These are the kind of things we need to address before we even talk about like flashy features and smart order routing to high optimization or spreading or these kind of things. We need to put the infrastructure first, and this is kind of like what we're doing.
Adam White mentioned that he didn't think institution would come this year, but maybe next year or the following year. Do you have any view on the timelines for institutional flow?
Yeah, I think I think it's not a binary scale. I think that institutions are coming, but it depends what you even call institutions. For us, the initial clients that we're interacting with are crypto funds that are below 100 million AUM. Those are going to be the core clients that we're going to be launching with right now. But we do think that we're going to see, some sort of a curve of adoption. I totally agree with Adam. I think we're talking about a multi-year exercise. So right before this role, I was the head of trading technology at AQR. We explored getting into the crypto market. There's no question. But the ecosystem was not there and the scale was not there. So for a large organization like AQR that safeguards people's pension funds to spin up 3 different organizations, right? You want to do research systematically, you want to do trading systematically, and you want to do operations also systematically. Quite a lot of people. You need to understand what the return in the market is going to be. AQR is larger than the entire crypto sector, so we couldn't get involved. So we're going to see those institutions, but that's going to be the tail that Adam was mentioning.
Do you have a favorite exchange? Sorry. If anybody else has questions, do you have a favorite exchange?
I don't have a favorite exchange. We work with all of them and we like them equally like our children. Thanks a lot.
Thanks, Anton.
Thank you.
So first of all, how many people here are students? A lot of students? Good. Yeah, so I've been sort of a friend of HBS. I didn't go to Harvard, I went to Yale. For many years now. One of my angel investors of an early company I was in is now a professor of finance. He was my college roommate, and I've mentored students at the iLab for the past 6 or 8 years, particularly around sort of logistics and transportation businesses. But I was excited to get into a new role this year. My company is Staked, and I founded it with a friend of mine from college who is an entrepreneur with a lot of experience. And I have a diversified background in technology from transportation technology. I was an aerospace engineer right out of college. Actually moved here 20 years ago and joined a Harvard startup over on Western Avenue, the 7th employee, first one who hadn't gone to Harvard. So that was always interesting. And had the opportunity over the past couple of years to work on a very large cloud infrastructure consulting engagement with a big company that has some roots in Boston, but basically they do the clearing for all of the stock and equity trades that happen on Wall Street. And the number at some point that was kicked around was about $50 billion a day, which works out to something like $15 trillion a year. And all of this technology is on old school mainframes running COBOL from 1975, which is almost as old as I am, and I'm sure as old as, much older than many of you. And so as I was doing that, I was, with all of the modern cloud technology that exists and now with blockchain, it was making me think of what is that sort of next disruptive technology that's going to, put the 45-year-old mainframe technology out. And it just so happened at about the same time, my friend gave me a call about something completely unbusiness related, social, and it was like, well, what are you doing? And he said, well, we got this idea for this new thing called staking. And I was like, well, that's pretty interesting. Like, how does it work? He's like, well, you run some EC2 instances and you can stake. And I'm like, no, we can do much better than that. So that's how stake was sort of started. So proof of stake is replacing proof of work. And so I'm the CTO, so I'm not sure of all of the validity of these numbers. My co-founder was able to dig them up as we were raising money last year. And in fact, I think some of them probably changed. But the point is it's a very big opportunity. There are myriad new coins that have either launched or will be launching in the next year or two. Algorand is one that we're already on the testnet right now to support. But the point is that there's a very big opportunity for stakeable assets. And so some people might say, well, what is staking? Basically, the idea is that if you own the asset, then you are obligated to some extent, but also have the opportunity to create a passive yield on that asset. And so, much like existing securities where there's interest in typical loan, where there's sort of a rate of return on bonds, that's where proof of stake is going. And so, what we see is the opportunity to, earn a yield on sort of a capital asset that you've just invested it in, and also avoid dilution as the chain evolves. But in order to do it, it requires 24/7 servers, security, and monitoring. So that's where our product comes in. I like to call it block ops, which is sort of blockchain and DevOps. When you look up blockups, though, you'll find basically a Minecraft merged with Call of Duty, which is a kid's game, which I thought was fun. So what does this new world require? Our position at the moment is diversification. So we're racing as fast as possible to support as many stakeable assets as possible, so that our institutional investors who want to invest or stake their portfolio with us have as many options as possible. And like I said, reliably and securely earn those rewards. We're not a custody provider. We don't need to be a custody provider. What we're providing and what I'm actively working on is basically an SDK and API that allows both end users, retail users, but also institutional exchanges, OTC, the Talos guys, we should probably talk, to basically provide you with the delegation transaction for your users to sign so that we can then provide that delegation service on your behalf. And as part of that, we have detailed reporting and yield analysis so that you can understand how your assets are being put to work. So So this is not a complete list of the things that we currently support, and is also a list. There probably needs to be some TBDs on a couple of these other things. But I mean, we're basically making money for our customers right now with Tezos, Livesphere, Decred. Let's see, EOS, we're a producer there. Dash is another currency that we're supporting. And so, we basically built a little factory to say, okay, when a chain that's offering proof of stake wants to be made available, and we're customer driven, so it's whatever our customers hold, which is what we'll build. We're able to turn that around and leverage our existing technology to within weeks be able to support that that chain, leveraging the fact that we have security, alerting and monitoring of the whole system. I like to call what we do not necessarily in the cloud. We'll go to the next slide here in a second, but more we're operating in the atmosphere. So we've got the traditional large cloud providers, as well as on-prem servers, as well as some non-traditional cloud providers, so that we basically have a fault tolerance, high availability, and disaster recovery scenario for our customers. Our typical customer looks like smaller funds and individuals who want to pool their assets to stake, and then we manage the divvying up of those staking rewards. The actual payment happens on the chain. We're not responsible. You don't have to trust us to do the paying. But what we do is provide the reporting so that you can actually see in one place how each of your chains is performing. And then, as I mentioned, for larger customers, exchanges, other funds, OTT desks, I'm working on this integration framework to be able to support them. I won't geek out with the technology. If you want to geek out with technology, you can come talk to me. And if you want to talk business, then I can refer to my partners. But I mean, basically, the blockchain is designed for the atmosphere, like I said, which is a collection of all the clouds. We leverage all of that. Security is of utmost importance. So we have, everything is rigged with intrusion detection, automation to be able to shut it down if we detect something has been intruded upon, failover keys when that's been detected, and we even use hardware signing modules for some of the chains that we support. So that was a whole mouthful of technology. Like I said, if you want to talk about it more, you can. So where we see that there are other compounding opportunities, there's staking that exists today, and last year when we secured our A round with our biggest customer, we're looking at this year lending as a natural sort of opportunity to combine with staking. That is going to involve some smart contract development. And then, ultimately into the future, funds that are basically built around yield seeking, akin to your big sort of municipal bond funds and things like that. This is our team. Like I said, if you want to talk to Tim or Jonathan, Jonathan's very active on all of the chain's sort of social media channels, and Tim is our visionary CEO, who I've known for 25 years. So that's all I've got. If you have a couple questions now.
Are you able to do staking without your platform, like currently? And if so, how would you do that?
So basically what's involved is everybody who owns an asset can do it. And there are competitors, like in any space, there are people who are going to pop up and compete with us. Where we're focused is on the institutional investor, one-stop shop, who has a diverse portfolio that they can do it all with us. Secondly, because of my background in cloud infrastructure technology and really sort of seeing how things need to happen at scale and how to happen securely with proper failover, that's where we see ourselves differentiating. That said, if you own Tezos, you can either go and get yourself an EC2 instance and go to the software, GitHub, download the software, figure out how to run it, figure out how to monitor it, keep it up and secure. There are some other makers that you could do that with as well. So it's a growing, evolving ecosystem. We're excited to be sort of some pioneers and leaders, and I think mainly we raised a Series A. Oh, I forgot to mention, I'm also hiring, so we're looking for some analysts and some engineers. So if you're interested in that. Analysts and engineers.
Thank you. My name is Joe Taussig.
our business model historically is to think up innovative things in insurance, reinsurance, banking, broker-dealers, and businesses support those. Pull the people together, capitalize them. And most of our capital comes out of the hedge fund business. Some of the companies have achieved billion-dollar market caps if they're publicly traded, or billion-dollar net worths. So this is an outgrowth of this. I came across a company called Salt Lending about 10 months ago. And they're margin lending and what we call a direct lending fund. And margin lending is something I know a lot about, which you'll see in a bit. And I said, my God, this is the wrong way to do it. The right way to do it is have a bank and raise cheap deposits and do the margin lending. So I approached 4 players, and one of them is a company called Rocky Mountain Bank in Wyoming. And the chairman and the largest shareholder is a long-standing business partner, over 30 years, 4 adventures together, 3 which achieved more than $1 billion of value at some point in time. And he said, well, let's go for it. I like this, okay? Well, we just signed our contract yesterday. So from May to yesterday, it was all kinds of regulatory issues and all kinds of struggles. And the pain point we're trying to solve is the ability for people to borrow fiat against their crypto. And I'll explain why that is and the economics. And the other is just to simply open a bank account. Anybody who's done anything with an ICO, a miner, or anything else finds it's impossible almost to open a bank account. So phase 1 is to generate deposits for Rocky Mountain Bank. No capital needed. It's a very low capital impact business. Second is to start non-US banks in order to make margin loans. We've decided it's not going to be practical to do that within the United States. Immodestly, I'm a world-class regulatory and tax arbitrageur. I've started financial services companies in at least 12 countries. I live in Switzerland. You can do the math. And became Swiss. Okay, this is all Rocky Mountain Bank here. The most important thing is number 4. They've passed 8 pieces of legislation in Wyoming, one of which is to have what they call special purpose depository companies. That was just passed early this month. So in the bio, it said 5. They've added 3 more in this month. It's the most crypto-friendly state in the United States by far, and they're trying to attract a lot of businesses. Pain point is bank accounts. Anybody who's got a crypto business knows it's very difficult to open a bank account just to pay your people. So you can't buy much with crypto that you need, like rent, electricity, staff costs. They can't pay today. You can't buy food, groceries, or whatever. And there are only 6 other banks that are really actively soliciting deposits. Quickly, I'll talk about 3 of them: Silicon Valley Bank, Signature Bank, and Silvergate. So Silicon Valley Bank is primarily catering to crypto businesses seeded by Silicon Valley VCs. It's really an accommodation to the Andreessen Horowitzes, the Ribbits, the Indexes, et cetera. Signature officially requires a $20 million deposit, okay? Silvergate, which is interesting, just filed for an IPO in November. And if you look at it, they've raised $1.7 billion worth of deposits in 2 years, paying very little for the interest. And you'll see that's why the economics are kind of attractive here. It's perceived as a compliance nightmare. That is why very few banks want it. That if you're a compliance officer today, or even in the chain of command in some countries, if you have any bad guys in your bank, you can be personally liable for it. And when you have low interest rates, you don't have much to do with the money. So it's just better to say no. Remember, Compliance 101 school is how to say no in 47 languages. Okay. So our differentiation, we're going to be willing to open smaller accounts, very speedy approval. Some of these things take 12 weeks to get an account open from the time you fill and we'll pay higher interest rates. And because we're a much smaller bank, Silicon Valley and Signature both have $5 billion balance sheets. And they're not going to raise interest rates to compete with a minnow, if you would, to do this. That will be our differentiation. So the economics of it. So these are the peak sizes of the business, you know. The Fed rate is 2.5%. So if we take a deposit and we put the money at the Fed, that's all we have to do. We don't have to loan it out or put it at risk on bad loans or anything like that. We earn 2.5% today. So we took $100 million of deposits and we had to give about 20% of our Fed rate. It increases the ROE by 67% of the bank. And this is a profitable bank at about 10% ROE right now. At 100 million at 80%, we'd still. So we're talking to stablecoin people who can put 100 million in, okay? And if we give them 80% of the interest, we still increase the ROE by 17%. And if you go to Silvergate at $1.6 billion, that's 16 times as much. This is a pretty good trade for a small bank. Pain point, loans collateralized by crypto. Crypto to crypto or crypto to fiat in most jurisdictions is a taxable event. So if you're a New Yorker and you have crypto, and particularly if you've been a miner, there are people who, Deloitte, for example, will tell you a miner owes taxes the minute they take it. It shouldn't be, because if you dig for gold in the ground, you're not taxable till you sell the gold. But supposedly when you take delivery, they think that it's taxable, okay? If you sell, your after-tax cash might be similar to if you have a 50% loan-to-value margin loan. But the 50% loan-to-value generates almost as much tax, but the hodler gets access to cash and keeps the upside. Okay? Allows tax-efficient levered returns for true believers. If you believe that this winter that we've had in the last year is temporary, this is a great time to borrow to get the upside, if you would. It also provides borrow for short sellers. Okay. It's currently provided primarily by direct lending funds and peer-to-peer platforms. We see it as about $250 million was raised by it. Some of them never converted to fiat. So a good example is a company called Celsius, raised $50 million, but it did it in Ether and they did it at the high. So I have no idea how much powder they really have to lend today, but I suspect it's a lot less than $50 million. The demand at the time a year ago, we thought was between 5 and 10 billion. And just to kind of give you a sense of how margin works in America, 2% of the entire capital markets is the margin loans that are made right now. Equities markets in America is the margin loans, 600 billion. And I would argue that crypto would be more inclined to do a margin loan than necessarily Apple stock. So the lending economics, right now they're charging 15 to 20%. A fund with $1 million can only lend $1 million, generating 150 to 200K of net interest margin. NIM is kind of like an operating margin. Think of it like EBITDA, sort of in bank speak. A bank with $1 million can lend 11 million, okay? Generating 165 to 215 of NIM. Deposit costs on 10 million would be about 200 grand, okay? And consequently, the NIM per million of capital would be 145 to 195 at current interest rates. If they compress, and we think they'll compress down the road, even at 10%, you get a 90% ROE, basically. At 6%, 46. Right. In the US, this should have been a no-brainer. Unfortunately, it's the impossible dream. And it's all the regulatory hurdles we've gone through to try to get ourselves in position to do this. Rocky Mountain International is how we're going to solve this internationally. We're going to create banks outside of the US. So in terms of the key success factors are starting and operating banks, margin lending, and cheap deposits. So essentially, my track record in starting and operating banks, I created the 4th bank in Bermuda. There are only 4 now. Okay. And we acquired a Swiss bank in 2008. We created 2 in Malta. These are 3 very crypto-friendly countries. I've met with all the regulators. I'm pretty comfortable. I know how to put this stuff together, et cetera. I oversaw margin lending in a place called Wedbush Securities manually in the 70s. I was the financial officer. 100,000 accounts manually. I know margin lending. And lastly, one of the companies we created was a deposit broker in the UK, raised 3 billion sterling over the internet, government guaranteed deposits, less than 2%. So we know how to start and operate, we know how margin lending, we know how to raise cheap deposits. And the idea is to have the maximum minimum you can have. Sure, thank you.
Hey everyone, I'm Alex Patin. I'm the Blockchain Innovation Fellow at Harvard and the co-founder of Squarelink. So a little over a year ago, my co-founders and I, we were working on a conference management and ticketing platform on the blockchain. So essentially something where smart contracts could execute the booking of flights, hotels, and registration for a conference all in one click. Obviously, didn't work out too well because you all came here using Eventbrite. But anyway, we learned a lot along the way, learned a lot about what modern Web3 developers are struggling with in terms of like blockchain usability, things like that. So we were ultimately building something that everyone should be able to use. But when it came to building the front door to our application, so how people are signing transactions, signing into the application, et cetera, things started to break down. And just like many Web3 applications today, we had to make the choice between requiring our users to interact with our dApp via MetaMask or to do something like build a custom custodial solution. But that gets really messy. It also defeats the purpose of blockchain. Anyway, there are a lot of solutions out there that employ the use of brain wallets, essentially like private keys derived from a username and password or something similar. But even there, we realized there was still a key piece that was holding back that mainstream adoption using that method, and that was private key recovery. So now people in blockchain often bring up the UX flaws with Web 2. Namely being like, if you want to register for a new application, that's another login, another set of credentials that you have to manage yourself. And that piles up, especially over 20 years or so. And with blockchain, like a lot of the draw for that was that you'd have this single account to access any blockchain applications. It didn't turn out like that. And nowadays, people are whenever you sign up for a new wallet, you have to write down your 12-word mnemonic device on a piece of paper. Keep that piece of paper safe. And at least, I don't know about you guys, but like I have like 50 blockchain wallets and I still haven't saved a single piece of paper. So it gets messy. So to solve this blockchain usability problem, we decided to tackle that issue of private key recovery. So we went through like every common method of password reset in typical Web 2 applications and found ways to make them non-custodial. So what we wound up with, in my opinion, is the perfect balance between security and UX to drive the mainstream adoption of blockchain applications. So we essentially built a single sign-on for the blockchain where people can sign transactions and recover private keys on any blockchain, any device, using just an email and password, and also keep everything non-custodial. So to repeat that, people can sign transactions, recover private keys on any blockchain, any device, keeping everything non-custodial. So that's sort of the holy grail for blockchain usability, and a little too good to be true. So I'll get a little into the weeds with how private key recovery works. So as the most basic example and our original proof of concept for the idea, we released the idea of we released a method using challenge questions. So essentially with Web 2 applications, you answer your challenge questions, your security questions, and they're stored on a back end to be validated later. Rather, with our approach, we use those answers to your challenge questions and hash them in order to create a recovery key. With that recovery key, we encrypt all of your other private keys. And in that method, if you're able to reproduce those same answers again, you can therefore decrypt that original master key that you owned. So I imagine a lot of you are probably screaming on the inside at the thought of security questions. So that's fair. So we also offer other methods that employ the use of PGP encryption with email and SMS to add additional layers of security. And on our back end, for every account, we also have a centrally stored salt, which is basically a long random value that adds entropy to a user's resulting private keys or their resulting recovery keys. And that salt itself can be protected with like two-factor authentication. So every user has the ability to upgrade their level of security. Everyone has, basically customizable security. Yeah, so now the people currently using Squarelink, no one really has like $20 million of Bitcoin in their wallets, but this is really the perfect solution to enable high-frequency, low-value transactions that are necessary for a lot of these like mainstream dApps to succeed. So user experience aside, the developer experience, I don't know, who here is a blockchain developer? Who does, anyone here build dApps? Cool. So do you work for MetaMask by any chance? Awesome. Yeah, the developer experience in blockchain right now, especially for Ethereum, kind of sucks, namely MetaMask. And if you're coming from a Web 2 application development background, you're familiar with services like Stripe or PayPal's SDK or any REST API, OAuth-based API. So if you're coming from that into a Web 3 environment where you're forced to use the MetaMask development workflow, you're just like you're in for a world of pain. So we wanted to take our approach a step further and start to improve that development experience. So with our platform, we offer a very familiar OAuth style integration for dApps and a standard OAuth-based REST API. So you can basically interact with your users with all the same functionality that MetaMask would offer, but from more of a Web 2 perspective. So we launched our public beta a couple months ago. We currently offer Bitcoin, Litecoin, and Ethereum wallets, as well as tooling for developers to build Squarelink into their applications. But one thing that we quickly learned was that Web3 developers are currently so entrenched with the MetaMask development workflow that switching to something that was simple and intuitive was impossible. On that note, we have some exciting updates about the Squarelink project. In a couple weeks, we're actually going to be launching our version 2 beta, which you can all sign up for on squarelink.com. It should be on our landing page. You can also check out a demo at the bottom of the page, which shows you the sign in and sign transaction OAuth buttons. With version 2, Squarelink is going to be a full standard Web 3 provider. You'll be able to import, we'll be offering a JavaScript plugin so current MetaMask users can quickly import a script that switches them over from MetaMask to Squarelink, super easy. Shameless plugs, we're hiring developers across the board right now. If you're a dApp developer, come talk to me. Cool. Questions? Yeah.
So basically, this is all client-side encryption.
It's all client-side encryption, right?
And so you have you have a security questions method.
Right.
What were the other?
The other two, so the one we have that's currently available is PGP-based encryption with email. So if you have PGP enabled on your email, we have basically scrapers on the back end that go through like MIT's key server, a couple other public key servers, try to find your public key and can encrypt your master key with that PGP key. And then when you want to recover your account, sends you an email, you would be the only person who can actually decrypt that.
So those are your two ways?
Currently are two ways, yeah. Thanks, guys.